Marico's traditional business is slowing, but its premium and digital brands are going aggressively. Could this completely change the companies for the next 5 years? Let's have a look at the company's Q4 FY26 conference call highlights. Marico reported a revenue of 3,333 crores in Q4 FY26. It grew 22% year on year, wherein the India business delivered a 9% volume growth with over 95% of the portfolio gaining or maintaining its market share. Parachute hair oil, which contributes 36% of the India's revenues, saw a slight 1% volume decline, which suggests some pressure in the core category. Saffola edible oil, which contributes 17%, delivered steady growth with mid-single-digit volume increase. But the real performer was value-added hair oils. This segment grew 26% in value, with market share gains clearly indicating a premiumization play. Now coming to a new age business, the food segment grew 16%, moving closer to a 1,000 crore scale, driven by innovations and brands like 400,000 BC and Cosmic. Geography-wise, Bangladesh delivered a strong 35% growth. Vietnam maintained a momentum at 18%. South Africa grew 8%, while the Middle East declined 7% due to geopolitical issues. So, the overall revenue growth is strong but mixed underneath. To the most important part, the margins. EBITDA stood at 521 crores, up 14% year on year, but the margins came in at 15.6%, declining 120 basis points year on year and 110 basis points sequentially. Despite strong revenue growth, margins are under pressure. Input costs remain elevated as packaging inflation was 6 to 7%, liquid paraffin cost increased 2% year on year, and the rice bran oil prices also increased. As a result, material costs surged 31% year on year. Now, here's the interesting part. Copra prices declined 35% from peak, which helped improve the gross margin by 140 basis points. So, we have a situation here where one raw material price is helping and the others are putting pressure. PAT came in at 400 crores and an increase of 18% year on year. So, clearly, growth is intact, but the profitability is being squeezed. Now, let's talk about what Marico is building for the future. The biggest strategy move here is the Say2 distribution expansion. This is a 3-year structured rollout plan, expanding rural reach across India, strengthening last mile distribution, and improving market penetration. And it's already showing results, gain in both distribution and market share. At the same time, urban expansion is also underway through channels like chemist, cosmetic stores, and specialty food outlets. So this is a dual strategy, rural deepening plus urban premiumization. And that's the most powerful combination in FMCG. Looking ahead, management remains confident. The company is targeting double-digit revenue growth, 15,000 crores top line by FY27, 20,000 crores by FY30. And importantly, the margin maintaining is around the mid-teens. And importantly, maintaining mid-teen EBITDA margin, the real growth lever going forward. It's the premium and the digital first brands like Beardo and Pix. These segments have 20-25% growth runaway and operates in higher margin categories. So the strategy is clear. Move up the value chain, build premium portfolio, drive digital-led growth. If I summarize this entire call, Marico appears to be moving beyond its traditional FMCG identity and gradually position itself as a premium, innovation-led consumer company. With short-term margin pressure continue due to elevated input costs, the company's long-term strategy around premiumization, digital-first brands, and distribution expansion remains firmly on track. If management continues executing well, Marico could build a much stronger and a more diversified growth engine over the coming years. The key monitorable going forward will be whether premium growth can sustainably offset ongoing cost pressures or support margin recovery. The key question going forward will be whether the premium growth can offset the ongoing cost pressure and support margin recovery. If you found this breakdown valuable, make sure to like, subscribe, and share with someone who is serious about markets.